Welcome to this guide on the exponential moving average. Today, we are going to dive deep into this fascinating tool that traders use to better understand the markets. By the end of this journey, you will know exactly how to use the exponential moving average to enhance your trading strategies. You will understand why the exponential moving average is different from other moving averages and how it can give you an edge in your trading decisions. So stick around because we are just getting started. Imagine you are navigating a winding mountain road. You need something responsive, something that keeps you ahead of every twist and turn. The exponential moving average is like that quick, reliable steering wheel that lets you react instantly to every curve the market throws at you. Now you might be asking yourself, what exactly is an exponential moving average? The exponential moving average is a special type of moving average that gives more weight to recent price data. This means that it responds faster to changes in the market. This makes it quite different from the simple moving average, which treats all day points as equally important. By focusing more on the recent data, the exponential moving average helps traders see changes in trends sooner. This is super important for anyone who wants to react quickly to market changes. It is also helpful to understand how exponential moving averages can be combined with common chart patterns. Chart patterns are visual representations of price movements that help traders predict what might happen next. Some popular chart patterns include head and shoulders, double tops and bottoms, triangles, flags, and pennants. When paired with the exponential moving average, these patterns can become even more powerful for making trading decisions. For example, in a head and shoulders pattern, traders look for a peak the head with two smaller peaks on either side the shoulders. If the price breaks below the neckline of this pattern while also crossing below an exponential moving average, it can confirm a reversal and signal a strong opportunity to sell. Similarly, a double top or double bottom pattern can be confirmed by observing how the price interacts with the exponential moving average. If the price breaks below an exponential moving average after forming a double top, it strengthens the signal that the price will continue downward. Triangles are another chart pattern that can be used effectively with exponential moving averages. In an ascending triangle, for instance, the price makes higher lows and forms a flat resistance level. If the price breaks above the resistance while also crossing above an exponential moving average, it often signals a strong bullish trend. On the other hand, in a descending triangle, a break below support with the price moving under the exponential moving average can signal a bearish move. Flags and pennants are continuation patterns that show a brief consolidation before the trend continues in the same direction. When the price breaks out of a flag or pennant and crosses above an exponential moving average, it signals that the trend is resuming with strength. Watching how the price behaves around the exponential moving average can help confirm whether the breakout is legitimate or not. By combining exponential moving averages with these well-known chart patterns, you can gain a clearer picture of market sentiment and identify strong trade opportunities. Whether you are looking for reversals, continuations, or trend confirmations, using chart patterns alongside exponential moving averages gives you the tools to make more informed decisions. Picture this. You are in a market where prices are changing fast. You want a tool that helps you react just as quickly. The exponential moving average can do exactly that. It moves quickly with the price, allowing you to spot opportunities or potential risks much sooner. Whether you are day trading or following long-term trends, the exponential moving average can help you stay ahead of the game. Let us get into why many traders choose to use the exponential moving average. First and foremost, the exponential moving average is really good at responding quickly to price movements. Because it places more importance on the most recent data, it helps traders identify changes in the trend sooner than they would with a simple moving average. Imagine seeing a trend change moments before others notice it. This gives you an advantage. Another reason traders love the exponential moving average is that it can help spot trends and reversals. When the price moves above or below the exponential moving average, it can indicate the beginning of a new trend. If you can identify these changes early, you have a better chance of making a successful trade. Some of the most common time frames that traders use include the 12-day and 26-day exponential moving averages for short-term strategies, while the 50-day and 200-day exponential moving averages are popular for longer-term trends. Let us expand on how exponential moving averages can be combined with chart patterns to improve trading success. Chart patterns are formations created by the price movement of an asset, and they can provide clues about future price direction. By using exponential moving averages along with these chart patterns, you can confirm trends, reversals, and continuations with greater accuracy. One popular pattern is the head and shoulders pattern, which typically signals a trend reversal. The pattern consists of a central peak, the head, flanked by two smaller peaks, the shoulders. If the price breaks below the neckline of this formation while also crossing below an exponential moving average, it is a strong signal that the trend is reversing and provides an excellent opportunity to consider a sell position. Similarly, a double top or double bottom can signal potential reversals. A double top forms after two peaks at similar price levels, while a double bottom forms after two similar troughs. If the price breaks below an exponential moving average after forming a double top, it strengthens the signal that the trend is likely to continue downward. For a double bottom, a break above an exponential moving average can indicate that a reversal to the upside is underway. Triangles are also effective when used with exponential moving averages. In an ascending triangle, the price creates a series of higher lows but struggles to break above a flat resistance line. When the price finally breaks out above the resistance and crosses above an exponential moving average, it often signals a bullish trend continuation. The opposite is true for a descending triangle, where the price forms lower highs and has a flat support level. A break below this support level, with the price moving under the exponential moving average, confirms a bearish signal and can be a great opportunity to short the asset. Flags and pennants are continuation patterns that occur after a significant price movement, followed by a period of consolidation. These formations generally indicate that the previous trend will resume. If the price breaks out of a flag or pennant and crosses an exponential moving average, it signals that the previous trend is likely to continue with renewed strength. Watching how the price interacts with the exponential moving average during the breakout phase can help determine if the trend is genuine or if it might fail. Wedges are also common chart patterns that traders use to predict potential reversals. Falling wedges and rising wedges suggest the price is contracting, and a breakout can signal a strong move in the opposite direction of the wedge's slope. By combining wedges with exponential moving averages, traders can further validate whether the breakout is likely to be a true reversal or merely a false signal. Using these well-known chart patterns in conjunction with exponential moving averages helps provide multiple confirmations of potential price movements, making it easier to spot high-probability trade setups. By adding these extra layers of analysis, traders can become more confident in identifying reversals, continuations, and breakout opportunities, leading to more informed trading decisions. Let us take a moment to talk about how the exponential moving average is calculated. It might sound a bit complicated, but it really is not. The calculation starts with the current price and uses a special smoothing factor that makes the average more responsive to recent price changes. The formula might look intimidating, but the idea behind it is simple. The exponential moving average is designed to give more emphasis to recent prices and less to older data. This is what makes it such a valuable tool for tracking price movements. Imagine a 10-day exponential moving average. It focuses heavily on the last 10 days of price data, while older data has less influence on the result. This creates an average that follows the price much more closely, giving you quicker insights into how the market is shifting. Now that we have covered the basics of what the exponential moving average is and how it is calculated, let us talk about how to use it to identify trends. When the price of an asset is above the exponential moving average, it typically means that the market is in an uptrend. This could be a good time to buy or hold your position because the market seems strong. On the other hand, if the price is below the exponential moving average, this usually signals a downtrend. In this situation, you might consider selling or avoiding long trades altogether, since the market may continue to fall. A really useful strategy involves using exponential moving average crossovers to confirm these trends. For example, when a short-term exponential moving average crosses above a long-term exponential moving average, it often signals that an uptrend is beginning. If the short-term exponential moving average crosses below the long-term exponential moving average, it could be the start of a downtrend. One of the most common uses of the exponential moving average is to spot buy and sell signals through these crossovers. Let us break this down. A bullish crossover, which is a signal to buy, happens when a shorter-term exponential moving average, like the 12-day, crosses above a longer-term exponential moving average, like the 26-day. This tells us that the market is gaining momentum, and it might be a good time to buy. The opposite happens in a bearish crossover, which is a signal to sell. In this situation, the short-term exponential moving average crosses below the long-term exponential moving average, indicating that there is growing selling pressure in the market. Imagine you are following a stock and you see the 12-day exponential moving average crossing above the 26-day. This tells you that buying pressure is building and the price could be on the way up. Another powerful way to use the exponential moving average is by treating it as support or resistance. In an uptrend, the exponential moving average often acts as dynamic support. Even if the price dips, it may bounce off the exponential moving average and continue rising. This is why it is called dynamic support. The exponential moving average essentially acts as a floor during an uptrend, helping to guide the price upward. Traders often observe that the price tends to respect the exponential moving average during strong uptrends, meaning that even temporary declines will find support at this level before continuing higher. This behavior can be especially prominent with commonly used exponential moving averages like the 50-day or 200-day moving averages, which many traders use as benchmarks for support levels. The longer the price stays above the exponential moving average and continues to bounce from it, the more reliable this support becomes. In a downtrend, the exponential moving average can act as resistance. When the price moves up but struggles to break above the exponential moving average, it means that sellers are stepping in and the downward trend might continue. This is called dynamic resistance. Essentially, the exponential moving average acts like a ceiling that the price has difficulty breaking through. This resistance is more evident when the trend is strong, as the exponential moving average continues to push the price down each time it attempts to rally. For example, during a significant downtrend, traders might watch for the price to rise to the exponential moving average and then fail to break above it. This is often used as a signal to enter short positions, as it indicates that the trend is still intact. If the price breaks above the exponential moving average convincingly, it could suggest a weakening of the downtrend or even a potential reversal. In addition to this, chart patterns like bearish flags or descending triangles can provide further insight when combined with exponential moving averages. In the case of a bearish flag, the price typically moves downward rapidly, then enters a consolidation phase that forms a flag-like structure. If this consolidation occurs near an exponential moving average and the price fails to break above, it reinforces the bearish trend, signaling a potential continuation of the downtrend. Traders often look for the price to break below the lower boundary of the flag for an entry point, which is especially compelling if it aligns with the exponential moving average acting as resistance. Similarly, in a descending triangle pattern, the price forms lower highs and tests a consistent support level multiple times. If the price fails to cross above the exponential moving average during this consolidation and eventually breaks below the support level, it confirms a strong bearish signal. This confluence between chart pattern and the exponential moving average adds further confidence to short positions. Another scenario is the use of wedges, particularly rising wedges in a downtrend. A rising wedge forms when the price makes higher highs and higher lows, but the highs are not as steep as the lows, showing weakening momentum. If the price forms a rising wedge during a downtrend and approaches the exponential moving average, only to be rejected, it further solidifies the bearish outlook. A break below the wedge's lower boundary that also coincides with staying below the exponential moving average provides a strong entry signal for short trades. By incorporating these additional chart patterns with the exponential moving average, traders can gain a much clearer understanding of the overall market structure and use this insight to make more strategic trading decisions. By understanding how exponential moving averages act as dynamic support and resistance, traders can make more informed decisions about when to enter or exit trades. Combining these insights with other indicators and chart patterns, such as wedges or triangles, can give traders an even clearer understanding of potential market moves. To give you a real example, many traders look to the 50-day exponential moving average as a key level of support or resistance. Let us say the market is in an uptrend and the price pulls back but bounces off the 50-day exponential moving average. This might be a good time to consider buying because the trend looks like it will continue. The exponential moving average is even more effective when used alongside other indicators. Let us explore how to combine the exponential moving average with other tools to make better decisions. One example is pairing the exponential moving average with the relative strength index. If the price crosses above the exponential moving average and the relative strength index shows that the market is oversold, that makes for a strong buy signal. This combination can help you be more confident in your trades. You can also use the moving average convergence divergence indicator, which is actually built on exponential moving averages. When the moving average convergence divergence line crosses above the signal line during a bullish exponential moving average crossover, it adds even more confidence to your trade. And do not forget about volume. High volume can make these signals more reliable. If the price crosses above the exponential moving average with strong volume, there is more interest in the move, and it could be more trustworthy. Low volume could indicate a weak or even false trend. Now let us talk about some common mistakes that people make when using the exponential moving average. One of the biggest mistakes is overreacting to short-term price movements. Because the exponential moving average reacts quickly, it is easy to get caught up in minor price changes. It is important to remember that not every small movement is significant. Make sure you wait for a clear and confirmed signal before making any big decisions, and consider combining the exponential moving average with other indicators or chart patterns to increase the reliability of your analysis. Another common mistake is ignoring the bigger picture. The exponential moving average is a fantastic tool, but do not forget to look at other factors like news events, economic reports, or announcements that could be affecting the market. The bigger context is always important. And finally, do not forget to use stop losses. Even when you think the trend is strong, the market can surprise you. Stop losses protect your trade from unexpected reversals. Before you start using your real money, practice with the exponential moving average in a demo account. This is a great way to get comfortable without taking any financial risks. Practice spotting trends, crossovers, and support and resistance levels. It is also a good idea to track your performance by keeping a trading journal. Write down each trade and what you saw in the exponential moving average that made you decide to take action. Review your results to see what worked and where you can make improvements. Do not be afraid to experiment with different time frames either. Some traders do better with short-term exponential moving averages, while others prefer long-term ones. Try out both and find what suits your style best. To recap, the exponential moving average is a powerful tool that can help you identify trends, find buy and sell signals, and use support and resistance levels. Because it reacts faster to changes in price, it is perfect for traders who need to make timely decisions. Start by adding it to your charts, try out different time frames, and remember to use other indicators like the relative strength index or moving average convergence divergence to confirm your signals. The exponential moving average is a versatile tool that can be helpful for traders at all levels of experience. Keep practicing, and you will become more confident in using it to spot trends and make better trading decisions. As you continue to refine your strategy, you will start seeing improvements in no time. And remember, we are all learning together.